Bitcoin just got hammered, down nearly 1,800 points after the Fed's hawkish surprise. But here's the thing, the crowd is selling, the algorithms are liquidating, and that's exactly where the real opportunity is hiding. There is one danger zone and one hidden opportunity right now. I'll show you both. Because if you're shorting here without knowing this level, the market could rip your face off in a single hour. Stay to the end. I'm giving you 3 exact levels you can trade today. Let's get straight to it. Bitcoin is in a strong sell structure across every single time frame. Monthly, weekly, daily, 5H, and 1H, all flashing red. No debate. We are trending lower, but here's the critical nuance. The trend is bearish, but momentum is exhausted. The RSI is at 37.98, hovering just above oversold territory, and our Williams %R is at -5.3, which is deeply overbought on the downside. This is a seller exhaustion zone. Write this number down, 63,479. If we break below that level with conviction today, the entire structure resets and you can short it down to 62,474 without a second thought. That is your invalidation line for the bull thesis. The herd is panicking. Funding rates have likely flipped negative, meaning the majority of the market is short. When everyone is leaning one way, the exit door becomes very small. This is the volatility turn we live for. Let's build the framework from the top down. Start with the weekly chart. Price is trading way below the 50-week moving average at 69,857. And an even bigger distance from the 100-week at 73,029. We have a clear death cross dynamic forming. The bears are in absolute control. This isn't just a pullback. This is a structural breakdown. Drop down to the daily. The 200-day MA is sitting at 78,946. That's irrelevant now. We are thousands of points away. The 20-day MA is currently at 66,362. That is your new dynamic resistance. Until Bitcoin reclaims that, any rally is just a counter-trend bounce. Now, here's what most traders miss. The MACD on the daily is at -2,314.7 and expanding. That's bearish. However, look at the 4-hour chart. We have a classic negative divergence setup. Price just made a lower low, but the MACD histogram is showing a shallower lower low. This is the hidden bullish divergence that triggers a sharp squeeze. It's not a buy signal yet, but it is a warning shot to shorts.so. Where does that leave us on the 1-hour and 4-hour charts? The pivot point for the day is $64,937. That is the line in the sand. The immediate support is at S1, 63,479. Below that is the danger zone at S2, 62,474. If we freefall to S3, 61,016, it's a bloodbath on the upside. Resistance is right here at a 1, 65,941. Above that is the 4H MA20 cluster at R2, 67,399. And the ultimate bull trap level is a 3, 68,404. Here's the takeaway. We are in a descending channel. The bottom of this channel sits right around 63,479. If you look at the volume profile, that's also where the point of control from the previous consolidation lies. This is not just a random number. It's a high volume node. A break there means a true vacuum downside. Now, let's connect this to the real world. The 24-hour news is dominated by the Fed's updated dot plot showing a hawkish tilt. This hit risk sentiment hard. This is a brutal rotation. Watch the bond market. As the 10-year yield spikes, Bitcoin, the risk asset shadow, gets crushed. It's moving tick for tick with the Nasdaq futures. When tech sells off, Bitcoin sells off harder due to leverage. The institutional positioning is key here. We saw heavy ETF outflows yesterday. The smart money is de-risking, but here's the nuance. They are de-risking into strength. The recent sell-off is a reaction to a specific event, the Fed meeting. The what's priced in is a full-blown recession scare. For the next 1 to 2 weeks, the directional lean is bearish until we reclaim 65,941. But the risk of a V-shaped recovery is high because the data is lagging. Do you think Bitcoin bounces from 63,479 this week? Comment yes or no right now. I'm tracking consensus. Alright, let's get to the money. Most people skip this section. That's exactly where the money is made. Keep watching. Strategy 1, the sniper, conservative. This is for the patient trader. We are playing the hidden bullish divergence, but only if we get confirmation. The trigger condition is a 1-hour candle close above 64,200 with volume. This would put a higher low on the MACD, confirming the divergence is real and not a failure. Your stop loss is tight, 63,000. This is just below the critical S1 of 63,479, giving us a clean invalidation zone. If we break that, the divergence is dead. Target 1 is 65,941, R1. Target 2 is 66,500 for a 1.5 gain. This is a high probability mean reversion trade. What voids this setup? A close below 63,400 on the 30-minute chart. The sniper, conservative, entry, 64,200, 1H close above, stop loss, 63,000 take profit 1, 65,941 take profit 2, 66,500 risk, reward, 1:1.5 hour invalidation, void if 30M candle closes below 63,400. Strategy 2, the active trader, standard. If you are more active, you are likely already in a short position. For the active trader, the play is a breakdown, entry condition. If we close a 4-hour candle below 63,400, with force, you short the breakdown, stop loss, 64,400. This is above the old pivot and gives us a clear invalidation. This is the bull trap liquidation level. If we bounce back above 63,900, the breakdown is a fake out. Target 1 is 62,474, S2. Target 2 is 61,016, S3. The risk reward is incredible here. Once target 1 is hit, set a trailing stop to 62,900 to protect profits and let the runner ride. Type your breakout level for tomorrow in the comments now. Let's see who's aligned. The active trader, standard, entry, 63,400, 4H close below, stop loss, 64,400 take profit 1, 62,474 take profit 2, 61,016 risk, reward, 1:2.5 hour invalidation, void if 4H closes above 64,000. Strategy 3, the aggressor, high risk. Now, the aggressor play. This is counter trend. For those willing to catch the falling knife, entry condition, a wick down to 63,200 that immediately snaps back. We are looking for a fake out below the S1 level. Your stop is 62,900. It's a 300-point risk. Target 1 is a quick scalp at 65,000, and if we get momentum, target 2 is 65,941. Here's the warning. This is only for those who can lose small and manage risk aggressively. The trend is down. A break below 62,900 means the next stop is 60,000. The aggressor, high risk, entry, 63,200, immediate wick rejection, stop loss, 62,900 take profit 1, 65,000 take profit 2, 65,941 risk, reward, 1:2.8 hour invalidation, void if 30M candle closes below 62,900 before we close. A non-negotiable rule. Never risk more than 1 to 2% of your account per trade. In this volatility, position sizes must be cut in half. No positions through high-impact news. This is how you survive to trade the next big move. The market is a marathon, not a sprint. Let's bring it home. The single most critical level for tomorrow's session is 63,479. That is the floor right now. If we hold it, the divergence has a chance to play out. If we break it, it's a free fall to 62,474 and potentially 61,000. Tomorrow, my focus is on the divergence between S&P 500 gamma and Bitcoin liquidation levels. Don't miss that. If you want the full breakdown on the S&P 500 divergence and how it relates to the liquidity trap I just showed you, that video is live now. Tap the end screen, smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one.